Yeah, I mean, I think, there's not a lot of liquidity. Actually, liquidity is being taken away from the market in different ways. But there's certainly a lot of complacency in the market, particularly in the U.S. And I think that complacency comes from the fact that the market is expecting interest rates to eventually decline, which is supporting the market. The market is looking forward. But I think actually that's wrong, and historical precedent shows that when the Fed starts reducing interest rates, that's usually because they feel a recession is coming, and that provides a collapse in the market. So I think the markets are very complacent right now, and I would be very cautious about what's coming next. Right. So, I mean, I think the asset of choice, and it's been proven by the market, is gold. Without any doubt, this has been the best performing asset, and it's not just the best performing asset this year and last year. It's been the best performing asset for the last 20 years, and more actually. So, which is exceptional. So in this type of environment where currencies are being debased, gold is proving to be the best asset class, and I think it will continue to be that way. When it comes to fixed income, again, it's not very clear because of inflationary pressures. Where we find value at GAM is in the so-called CAT bond area, catastrophic bond area. Where GAM is a leader, and the advantage of that asset class is that it is totally decorrelated from equities and from fixed income. So first of all, I think we are in an enormous bubble, when it comes to AI and technology, and that has effect on the overall U.S. equity market. And so, from a tactical point of view, I think that the main point is to be as far away from the U.S. Equity market as, especially in terms of correlation. So on a tactical basis, we would be significantly underweight in the U.S. market, and then we would be going into markets which are less correlated to the U.S. market. And within developed economies, the market which is the least correlated to the U.S. market is Japan, and Japan, in my view, is probably the best equity market to consider in going forward. It was one of the best equity markets last year, and I think it will show that it's today Japan is only about 4% of the MSCI World Index. Japan used to be 50% plus of the MSCI World Index at its peak in 1989. So there's been a complete shift between US and Japan from the late 80s until today, and we think that there's going to be a rebalancing in terms of market cap between US and Japan. So Japan is a prime market of interest to me, and then probably emerging markets. Although in the short term, emerging markets tend to be correlated to the U.S., especially on the downside. But I think when the situation stabilizes, I think emerging markets, which are selling at all-time lows relative to the U.S. in terms of valuation, will prove to be a very interesting diversifier. I'm indifferent about Europe. I think by nature, if investors are significantly underweight in the US, they will be overweight in Europe. Whether Europe does well on an absolute term is a big question mark for me. Within a global developed market, I think Japan is really the place to be. No, I mean, it's exactly it's all the same. The same view. Being long gold, being long. Being short U.S. equities by nature means being out of the dollar. So the dollar will continue to remain the world reserve currency, but there is certainly a drive for de-dollarization, particularly when it comes to emerging market, China, India, Russia, and basically what we call the global south, is actually trying to move away from the dollar. They're transacting in a lot of the transactions are taking place in renminbi, in the Chinese currency. So I think the supremacy of the dollar is is going down, and that actually coincides with the fact that the U.S. wants to retreat from being the world leader in terms of geopolitics. Although right now, obviously, with the Iran crisis, they are stepping in, but in the last few years, whether it's been under Trump or even under Biden, the U.S. have wanted to retreat from the world scene. And that has an implication for the dollar. Also, we're seeing, the Chinese, the main central banks have been, especially in emerging markets, have been selling U.S. Treasury bonds to buy gold, to increase their gold reserves. So again, that puts pressure on the U.S. dollar. Yeah, gold is usually, if you look at the last crisis, whether it was 2000, the last stock market crashes. Whether it was in 2000 or 2008, gold was viewed as was like the ATM. So people redeemed, sold their gold holdings while the markets were crashing initially, and then gold went to much higher highs. So I think we saw the same in a few weeks ago when the market went down substantially. During the initial days of the Iranian crisis. Gold sold off, and then it's starting to go back up again. I think gold will make higher highs, and in general, I think we are in a mega cycle for commodities, not just gold, but all commodities. And so I'm very bullish on not so much on gold because it's gone up a lot. I think gold will continue to go higher, but I think the other commodities. Whether it's copper, other metals, and even agricultural commodities, I think we are in that type of cycle for commodities, and that's part of the debasement of currencies, in particular the U.S. dollar. So, first of all, the investor group that I'm leading to cover GAM or to control of GAM a little bit more than 2 years ago, 2.5 years ago. Stabilizing the assets has been one of the main objectives of the firm, and I think we were doing relatively well. There's been a change at two strategies last year, which caused some outflows which were not part of the part of the plan. But otherwise, we've been doing quite well at stabilizing the asset base, and from here I think we are in a growth phase. We've put together, we've restructured the company significantly. We've simplified the company significantly. We've also added some, particularly in the alternative space, and particularly in some of these asset classes that I've been talking about, whether it's commodities, cat bonds. Japan, a number of other strategies. We've been putting together strategies which are uncorrelated to particularly to U.S. equity and to what I perceive as being a significant risk to equity markets. So we're going into into asset classes which I think will be in high demand from investors, and so I do expect asset flows to increase significantly over the next few months and the next few years. So first of all, I don't think we compete against BlackRock and Amundi. These are, as you said, giant companies, but they're also supermarkets. In the financial, in the financial product area. GAM is not a supermarket. GAM, so in a way, BlackRock and Amundi are supermarkets, and we are, the exclusive. Retail business. Okay, we are the Hermes or Louis Vuitton. Okay, so it's a different type of business model where we strive by innovation, we strive by performance, we strive by different asset classes which are not necessarily covered by, or they may be covered by BlackRock, but within BlackRock or Amundi they would be submerged by especially by their passive strategies, which are very useful for investors. But there's a place for anybody that performs well, particularly if they are in asset classes which are in high demand. No, I will not rule out any merger and acquisition. It just depends on the opportunities of the market.